US gasoline prices have hit a record $5 and even more in some parts of the country, a sign the global economy remains in the unyielding grip of the highest inflation for 40 years. In response, the central bank announced its steepest benchmark interest rate rise in nearly 30 years to try to tame those price rises.
It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight, and inflation is much too high. Against this backdrop, today the Federal Open Market Committee raised its policy interest rate by 0.75 of a percentage point and anticipates that ongoing increases in that rate will be appropriate.
Having ruled out a rate hike this high just a month ago, Jerome Powell's U-turn reflects growing concerns that inflation is out of control.
0.75% is a huge jump for a Federal Reserve that initially wanted to gently wean businesses and consumers off ultra-low interest rates that were slashed to near zero to save the US economy from the COVID-19 pandemic. But now it really has no choice, with inflation soaring 8.6% at the last count. And now around half a dozen US cities are experiencing double-digit inflation.
And for some, rate hikes like this imposed upon people used to years of cheap credit increases the risk of tipping the economy into recession, even if the Fed now may have no other choice.
I don't think that the Fed will stop raising rates because of a concern of recession. It realizes that it has to get inflation under control.
Economists say the Fed's rates have little, if any, impact on gasoline prices. That leaves President Joe Biden urging energy companies to produce more supply and even reportedly contemplating cutting federal gas taxes. Owen Fairclough, CGTN, Washington.